In this week's Emily Now episode, we're talking about bridge financing. What is it? Why do you need it? What are some examples of how people have used it? And I'm going to talk a little bit about the cost of capital. Lots of people complain about high interest rates, but sometimes paying a high interest rate is the cost of doing business. Stay tuned. My name is Dylan Gallagher, founder of emilynow.ca. This is our weekly Emily Now episode that we put together because we believe that it's important for you to know more, because if you know more, then you can do more, and that looks like maybe saving for the future, investing in new opportunities, or giving back to the community around you. So these episodes focus on all things finance with a focus on debt, more specifically mortgages and loans. And emilynow.ca is a platform making it easier for those that need financing. So if you have questions, follow us on Twitter at EmilyNowCanada. You can like us on Facebook, subscribe to us on YouTube, or find us on Google+. But let's get started with this week's episode. And we tend to start with a few questions. So this week's first question is, what is bridge financing? Bridge financing is a term that gets thrown around a lot, but traditionally, bridge financing means that you're trying to bridge two events and you need some capital or you need some money for it. Bridge financing tends to be expensive. It's meant to help with a very, very short-term need. And normally, bridge financing has a very defined plan. So typically, you get bridge financing for a specific reason. You pay a certain amount of interest or fees for it, and then you get out. And kind of the classic way to explain it is, let's say that you own a home that you've put up for sale and it has successfully been sold, and you've decided to buy a new home. But you've got to close on the new home on, say, the 15th of the month, and the house that you're living in now that you've sold, you're not going to get the sale proceeds until maybe the 25th of the month. So when you close on your new home on the 15th, you're going to need your down payment, but you're not going to get it until 10 days later. Well, those 10 days require bridge financing, and that's kind of the classic example of how bridge financing is used. So in that case, banks will, if your new mortgage is with a certain bank, they might provide the bridge financing for you, but sometimes you might have to go outside of the bank to get it, and it's not necessarily the interest rate that becomes something that's very expensive. It actually becomes the fees and the costs that are involved in taking bridge financing for a short period of time. So that's what it is. Bridge financing is meant to give you some help while you're waiting for one or two different events to happen. It's typically very, very short term, and it has a very defined exit strategy. Our second question today is, why do some banks not want to provide bridge financing? And the reason is pretty simple. Traditional banks do in fact provide bridge financing in some circumstances. If you're purchasing a home with a bank and you let that bank know that, look, my down payment's not going to be available for a week or two because the closing of my other house isn't scheduled to happen, they might say, well, great, we'll give you the bridge financing. Maybe we'll do it at prime plus 6 or prime plus 3 or something like that. But outside of that, traditional banks don't get really excited about providing bridge financing. You tend to have to go to a mid-market lender or maybe even a private lender, because for traditional lenders that have big infrastructures and there's a big cost to putting a deal together, when they look at bridge financing, it's not very profitable. And the reality is that for the same amount of work that goes into putting a bridge financing deal together, they might as well have just done a normal deal. The costs are high, the interest is high, the fees are high, but even with the high cost of money, it still tends not to be very, very profitable for larger banks. So you tend to have to find smaller lenders that can give you the money, they'll charge you for it, then they'll get it back, and that's where you tend to get it. But the reason big banks don't do it, or banks in general don't do it, is because it tends not to be very profitable. The short-term nature of the deal means that they can't make enough money from how much they charge you, and so they just opt not to do it, and they give you the responsibility of wanting to do it. So hopefully that helps you understand a little bit more about why when you talk to your bank, they might not have been terribly excited about giving you bridge financing. I'm going to give you 3 examples of how bridge financing gets used out in the real world. We've talked a little bit about when you've sold your home and you're scheduled to close and get your down payment on, say, the 25th of the month, but you've bought a new home and you have to close on that home on the 15th of the month. So you have 10 days there where you're not going to have your down payment, and you tend to need bridge financing to help you bridge that period of time. But 2 other examples would be in commercial real estate, where bridge financing tends to get used is when somebody has a commercial property and they need to improve the property, and once they're done improving the property, then the property is going to be worth more, in which case they can refinance and pay out the bridge financing. So that you might buy a property for $1 million, and once you've done some improvements to it, maybe you've put a new roof on the building, or you've cleaned up the property a little bit, or you've increased the rent from all the tenants in the building, that now the property is worth, say, $1.8 million. Bridge financing could be used to help you pay for the cost to get it up to $1.8 million value, in which case once you're done, you walk across to the bank, refinance it, and pay out the bridge financing. That's kind of classically how bridge financing is used for commercial transactions. And in a business, we don't call it bridge financing, but the best use case for it is accounts receivable or factoring, where a company has delivered a service to a customer and the customer has 30, 60, 90 days to pay for that service. Well, in the meantime, the business might want to access that cash, so what they'll do is they'll finance that receivable so that they can pay their costs while they're waiting for that receivable to come in. And so bridge financing for a business tends to look like factoring or accounts receivable. So a couple of things to be careful of, whether you're using bridge financing for a residential transaction, a commercial transaction, even for your business, that you want to be sensitive to the costs. It's not usually the interest rate that you end up having to pay a lot of attention to, because the interest rate will be very, very high, but because you're borrowing money for such a short period of time, it doesn't really equal a lot of money. But it's the fees that you end up having to pay, because those are due and payable right up front, and they tend to be the most expensive part of getting bridge financing. So if you do in fact need bridge financing, that's what you want to watch out for. What are the costs involved? Not necessarily with the interest rate, but definitely with the fees and any other costs that you might incur once you've repaid the financing, like a penalty or an early payout fee or something like that. Thought I would talk a little bit about the cost of capital or borrowing, and helping to maybe explain a little bit more about how capital is a resource that's used. And I share this because some people panic when they hear about high interest rates that they're being quoted. I know certainly over this past week had an opportunity to look at a few deals where, because of time, the borrowers had a very short period of time in which they had to act, or they had to respond in some circumstances. And even though they would qualify for really, really affordable financing, because of time, they needed to exercise more expensive financing. And so in some cases, some borrowers just know that, okay, because I wasn't prepared, that's kind of the cost of what it's going to be to get the financing that I need. But in some cases, borrowers can be really taken aback by how expensive the financing can be if they're not prepared in many different circumstances. The trouble that I find with this whole cost of capital exercise, if I need the money now, I have to pay more for it. If I have a little bit of time, then that means I can afford to pay less for it. The whole idea there that people get sort of wound up about is when they take the money at high interest rates and they really look to maybe close a transaction or facilitate whatever it was they were looking to do, they end up not having a specific plan. If you're going to borrow really expensive financing, whether you borrow it for 30 days, 90 days, or maybe a year, classically, it's always important to have a plan. You have to know, why am I borrowing the money? What am I going to use it for? How can I afford it? Ultimately, how can I repay it? And so the cost of capital can become a problem when you don't have a plan, when you've just maybe off the cuff taken the money at higher rates of interest, but you don't have a very specific and articulated plan as to how you're going to pay it back or refinance it or get rid of it. And so many times borrowing money at higher interest rates can be the result of being crunched for time. That's usually when I've seen it happen the most. There are unique cases where the high interest rate money isn't because of time. It's because someone's made a mistake or they're in a really desperate place and they can't get out of it. But generally speaking, higher interest rate money is used because someone has either run out of time or they're trying to buy themselves more time. But in either case, it's really important to have a plan. So if you need money, there's always someone out there that's willing to give it to you, and they're always willing to do it at a price that is favorable to them and the circumstances. The more prepared you are, obviously, the better of a deal you can get on financing, and the less prepared you are, the more you're going to pay. And make sure that you're aware of that. And sometimes being able to take expensive financing to facilitate a deal makes sense. That's just an opportunity cost. Other times you don't have to. With a little bit more planning or maybe some creative deal making, you can find a way to avoid having to pay those the higher interest rates and avoid the cost of capital. In either case, if you wanted to see what kind of financing options you have available to you, we'd encourage you to visit emilynow.ca, where you can get prepared to be approved. You can see the private lenders, the mid-market lenders, the traditional lenders that will be able to help you out. And it's free, doesn't cost anything. We've got a great team here that can help you put your deal together if you're looking for a mortgage or a loan. And we thank you for tuning into this week's Emily Now episode. We look forward to seeing you next week.